So I think we'll give it another minute and we'll start. Good afternoon and welcome to the first Startup Investor Connect program which we are doing at C-Hub. This session is going to be structured in two parts. The first one is we're going to have a conversation with three eminent VCs on the panel, whom I'll introduce very shortly. And then post that, we also have a few startups which will be presenting their pitches, and the three panelists here will kind of critique the pitches, right? So just to set the context, this is really more of a almost an education series which we are trying to run. The whole intent was, given the huge surge in funding and the huge surge in the number of startups, right? All of them are looking to, for numbers, the numbers in terms of capital raise, the number of unicorns, etc., is really busy, right? And I think what everybody would like to get an understanding of is, when the three panelists, evaluate, and I'm sure they will probably tell us, they probably receive, on an average, maybe more than 10, 20 pitches a day, or even more maybe. How do they actually evaluate, and what is it that they look for when potentially they are looking to invest in an entrepreneur and in a startup? Okay? So that's the context. So two parts, as I said. One is in terms of trying to convey to our audience here a quick overview of what is it that potentially a funder would look for when the funder is looking to invest in an entrepreneur and a startup. And the second one is when we will have 5 startups making their pitches, and we'll have the panelists kind of telling us what is it that they like about the pitches and what are the potential gaps, deficiencies they'd like to address. Right? So without further ado, let me quickly introduce the panel we have here. I'll start with Abhiram Katta. Abhiram Katta is a director at India Partners, and Abhiram is by background the quintessential finance jock. He's a chartered accountant and an MBA from IIM Bangalore. And among the investments which Abhiram has been driving recently are with Scrut Automation, which is a joint investment with Lightspeed, then Glory, which is a SaaS management platform, and of course, I think Abhiram's firm was responsible for the creation of the first truly homegrown startup unicorn from Hyderabad, which is Darwinbox. So welcome, Abhiram, and look forward to our conversation as we go along.
Thanks, sir. Look forward.
Next up, we have Jatin. Jatin Desai from Inflexor Ventures. And, Jatin is currently a managing partner at Inflexor, the Fund 2, and he's also a GP or a general partner in Parampara early stage of opportunities Fund 1. Jatin brings over 25 years of global experience managing funds and investments, technology, and technology and operations roles. And he was also, Jatin has been both involved with the US side of funding as well as India. And some of his recent investments are in cybersecurity, a company called SecureThings.ai, where there was a 3.5 million investment led by Inflexor. And then Atomberg, consumer tech product company, along with Jambi. So welcome, Jatin, and look forward. And then we have from the financial capital of India, Bombay, we have Shivangi Bubna, who's a partner investments at Mumbai Angels. Shivangi again brings over 15 years of experience in consulting, finance, and corporate investor relationships. She's currently managing the lifecycle management of investments at Mumbai Angels. She manages about $100 million spread across about 190 investments. And some of our more recent investments are Booking Genie, which is a hospitality platform, Game Eon Studios. And folks, for all the entrepreneurs who are here, Mumbai Angels is also planning to launch a 200 billion fund. So please make sure that Shivangi is on your side. So with that, that introduction. So the format we are going to do, we are going to try and keep this very conversational. No death by PowerPoint, so I don't think any of the panelists have any slides, so we'll just keep this conversational. So let me start with a few questions, and we'll do this in the fashion where I'm going to pose a question to the panelists. So one of the panelists will be the lead for that question, and the other two panelists will chip in. So we'll try and keep this as conversational as we can. Right? So let's start with the first one. Right? Given the all the action around funding, and given all the unicorn plays and all of that, right? So I guess everyone who's starting out a business today thinks funding is something which should be relatively easy to obtain. Right? So let me start with a question first to Abhiram. Right? So Abhiram, one of the questions which a lot of people ask me is, when should I go and reach out to a particularly institutional funder for raising capital?
Great.
So is there a secret sauce, or is there a formula which you have to to define?
Yeah. So I think there are different investors, institutional investors, and each of them have a different criteria for investing, right? So I think today Indian ecosystem has matured reasonably enough to have funds addressing each stage of the life cycle of startups. So there are established angel networks and people raising 200 million funds from the angel networks itself. And you have micro VCs, you have specialized sector-specific VCs, you have VCs looking at early stage, early growth to growth Ps, etc., right? So that way, I think we have a lot of potential investors for the startups. So it is for the startup to think about it from their point of view, saying how much money do they need, and is it possible for them? So money is one aspect of it. Do they need money for the initial activities, whether for the design, prototyping, etc., the stage of it, or can they fund it themselves and then go for funding later? Because obviously, depending on the stage of the idea, the valuation, the risks, etc., will be different. So they need to, and also they'll be diluting their stake. The earlier the founders go for a fundraise, the earlier they will start getting diluted. So they'll have to take a call if they want to raise that money early on, get diluted. If so, then what are the benefits they're going to get? So money is one of the things, but there could also be areas where the institutional investors would be able to help them, right? From market connect to product validation, guiding them on just how to set up, think about the business, etc., right? So I think it's for the founders to decide if they want an external support from money perspective with regard to the other aspects, or do they want to take a few steps themselves based on their own bootstrapping, support from family, friends, etc., and then go to an institutional investor. like I said, there are people, institutional guys who are investing based on concepts drawn on Excel sheets and mockups, right? So there are people who are willing to invest even at that stage. So the founders will have to decide what is it they want out of this funding activity, and from the person who is actually writing the check.
Thanks, Abhiram. I think that was a great start. So let me now go to Shivangi. Shivangi, I think the point which Abhiram made, right, which is that even when somebody is going to reach out to potentially an institutional investor, what's the kind of homework the founder should do or the entrepreneur should do before he decides to reach out to the institutional investor?
Sure. So actually, I think Abhiram has highlighted most of the important points. It's actually a lot of it is dependent on the founder in terms of at what stage do they wish to dilute. I think is a very, very important question, because once you get onto the fundraising journey, it's only a series of dilutions that follow, which may not be a negative thing and should not be seen in that light. Because if without the capital, there might not be growth. But I think it's very clear to have a clear vision or objective in terms of what you're expecting apart from the capital. So at an angel or a pre-seed level or a seed level, I would say now the lines are blurring so much, it's difficult to pinpoint what level we operate at. What I would say is that the early stage investor brings in the 3 C's with capital, counsel, and connect. So if it's all these that a founder is looking for, then maybe an early stage investor, or maybe we like to say that we are the first institutional investors that come into the cap table. So that a platform such as ours might be the first go-to point if you are looking for a slightly more strategic investor than maybe a VC fund with a specific sector focus, where the council becomes more targeted and you have better connects. That could be the next touch point for a founder. So it really depends on, I think the one thing that the founder needs to address is what they are looking for, because funding is available at all stages. So while we may or may not pick up companies at a certain stage, there'll always be somebody else in the market who's funding them. So that particular clarity should come from the founder.
Thanks, Shivangi. I think the point about the 3 C's was a great one. And I hope all the entrepreneurs who've been listening have taken note of that. So let me turn to you now, Jatin. Right now, the other thing is, suppose let's say the whole founder has done his or her homework, right, and has identified that, let's say, for example, your fund is focused on certain specific themes, and typically the ticket size which they are raising is in line with what you are typically, writing checks for, right? How does he actually get to meet you? I mean, does he just send you, because you must be getting 500,000 pitches a day, right? How do you, so what's the best way, right, to actually be able to get to you?
Sure. So we have, I think for some of the early stage startups, we have a few channels through whom we get, how we source deals. One is, of course, the simplest one is, a startup applying on our website, through our website link, with the business plan. So that's the sort of the most easiest way to reach out to us. And I think obviously we can't respond to every email, but we have in our automated response, we've been very transparent saying, hey, whatever comes through this channel, every single deal is looked at by our internal team. Of course, some will make it, a lot of them may not make it, but every deal is given a serious look, right, before filtering in or out. So that's one channel, I think, the easiest one. Others are, of course, as funds, we attend lots of events, whether it's an incubator event or accelerator events, so I think that's where we get connected with some of the early stage startups. T-Hub obviously is a good example, of that, and many others. Also, I think, obviously some of them, if let's say you are stitching a $1 million round and you already have $500,000 of commitment from another institution or an angel network, so with our fund and angel network, we get to, they would share deals with us. So that's how we would find out. So for some of the early stage, these are the basic channels. Of course, as we move higher up the stage, then the investment bankers come into play and other sort of peer fund partners come into play as well.
So Jatin, at the risk of saying something controversial, you don't necessarily have to be from an IIT background to be able to raise funding, right?
Yeah, absolutely not. Obviously, See, I think it's kind of like, recruitment from campus, or, I think everything being equal, I think, some people just use that as a bit of filtering criteria, which I think you run a risk of losing out on some of the dark horses, right? So of course, we don't have any such criteria. And then in fact, we have publicly stated in media that, some of our good founders are not from IIT-IIM. Of course, there are many good founders in our portfolio who are from IIT-IIM, but we have a good mix. So yeah, you are right. That's not a sort of a holy grail that that has to be fulfilled. Yeah.
Hey, thanks, Jason. I think we've got this off to a really good start, and I'm hoping that all the 150 odd participants are getting some really great insights. So now let me kind of flip the order around, and I'll start with you, Jatin, right? And so what's the when people reach out to you, right, and they reach out to you, probably catch you in an elevator or whatever, right, and try and do the proverbial elevator pitch, if you will, right, or sometimes send you a slide deck, etc. What is the, let's say, I'm just trying to kind of list down for the benefit of our audience, what are the things you look for, right, when you're evaluating an idea and thinking whether it's worthy of funding, right? So what's the let's start with people talk about this thing called I look for vision and so on, right? Can you, for the benefit of our audience, kind of talk us a little bit through about what is this thing called vision which you look for?
Sure. So I think it depends on whether the founder or founders are in person or they are just sharing a deck, right? So obviously, if you are sharing a deck, there has to be clarity. So one is, of course, there are certain parameters that all funds will look at, and then since we are a tech or a deep tech fund, there are one or two additional criteria that we look at. So I think everybody will look at stuff like founder's profile and the problem that is getting solved, right? There should be a real life problem getting solved, because with many early stage companies, we see many Me Too copy models, or there are startups that we feel rightly or wrongly that these will be perpetually R&D or academic kind of projects, right? So that risk, of course, has to be eliminated. And
can we sorry to interrupt, can we dissect that a little bit more in terms of the problem statement? And if you can take a couple of sectors, let's say, B2B, B2C, B2C, or whatever, and just walk us through, what are some of the things you look for in those, the problems which they are trying to solve?
So I think, so for example, right, if you look at B2B, we are primarily B2B or enterprise focused fund. So if you look at the B2B or the enterprise sector, I think obviously, there has to be some technology-led innovation in the way they are trying to solve a problem, right? See, there are two things. One is there is an existing problem and there are existing solutions, right? So we look for more innovative solutions or tech-based solutions, to solve those problems. So be it, and we prefer recurring revenue SaaS-based models, for example, because there's a bit more certainty in the revenue, incoming revenue and stuff like that, right? And so that is one. And another one is, of course, you are trying to solve a new problem, right? Or a problem that is, that's still, not fully solved, right? So there, of course, the whole GTN strategy and, the profile of the founders, whether they can create a new market, in something that has not been touched too much earlier. So it would be slightly different way of looking at, both of these type of startups. But on the B2B side, it's, again, preferably SaaS-based pure software. If there is a hardware component involved, for example, right, it should not be trading revenue that you're importing hardware from China and selling it at a slightly higher margin. If hardware is involved, it should ideally be off the shelf, and your IP and your innovation should reside in the software. Because unfortunately, in Indian context, right, there's still a bit of negative perception on funding of hardware companies, right? I think it's a bit unfair because globally, I don't see that. But in Indian context, it's definitely a little bit tougher if you're a pure hardware play, especially if you're importing from China and just labeling it, right? So those are some of the things we look for in the B2B enterprise tech side of things, right? Yeah.
Thank you. Shivangi, you've done a bunch of consumer startups as well, right? So let's hear it from you on what do you see from when you're evaluating a B2C or a D2C? I think we'll run out of alphabets like
I'll try and keep this quick.
COVID variant. But yeah, but let's hear it from you.
Yeah. So I think apart from the standard filtering criteria, which I think most investors funds would apply in terms of size, scale, founders, etc. I think one thing that is very, very important, which I think Abhiram had briefly touched upon, is the cap structure of the company. Because the founder comes to us highly diluted to start with it. Though the idea might look interesting, but in terms of scalability and future fundraise, especially at the stage that we invest in, that might be an area of concern. If the founder has only 20-30% equity when they come to us, it's a pretty large challenge to wrap our heads around. I think in terms of sectors or in terms of business models, I think I like to put it on the price versus volume axis, because that every business can be pegged on that, whether it is a SaaS model, whether it is a consumer company. And given that we're a sector agnostic platform, that's a model that works for us. Where anything that is high price, high volume is a beautiful business to be in. I think all investors want to look at it. Something that is low volume but at a high price point is also has a certain scalability built into it. Something that's at a high volume but a low price point again has a scalability aspect in terms of the business model that can be built on it. But something that is at a low price point and has a low volume as a market might be an area of concern in terms of scalability and growth. Hence, what we look at and what we believe in is that not every great product makes for a great business. So what we look for is a business sense that is there in the idea that comes to us. And we have built an entire algorithm around it, because now we have about over 190 investee companies as a platform. And in a year, we typically evaluate 8 to 10,000 companies. So at least the first shortlist, I think we have managed to take a stab at.
So, Shivani, is that platform open sourceable? Or
we will eventually. So we are building the tech, and the plan is in the next 1 year, we'll actually make the MA Dynamics core available to the ecosystem. So while you might not see the logic behind it, but we want everybody to be able to use it to shortlist companies.
Thank you. Okay, Abhiram, let me turn to you on the other thing I've been thinking about. Right? So obviously, you need obviously to build large companies. You need great entrepreneurs and great teams to build large companies. So talk us through a little bit about when you look at it from a team standpoint. Right? What are the characteristics which you look for typically in a team which you're likely to find? What is there a mix? Are you okay to do? Is there a preference for single founders, or do you like to have a bus full of founders together? Is there any particular preference?
Right. No, that's a very valid question. So generally speaking, we have seen most of the startups having more than one founder, right? So generally, it's a team of co-founders coming together and starting up. But having said that, there is no specific rule that says single founder startups will not be funded, right? But the way we look at it is we again invest early stage at seed and pre-series A, and that's the stage where there is a lot to be done and thought about, and also from an institution building perspective, right? People are still trying to figure out what's the exact solution they need to provide, keep testing it out, do pilots, MVPs, build necessary team members, either from a technical standpoint or from a BD standpoint or from a product standpoint. So that way, there are lots of things happening in the early days of startup. And if it is one founder who is running all this, how much time and bandwidth and energy would that one person have? So that's the aspect that we look at, saying, is this person having all the skill sets, or most of the people will not be having the highest ranking on all parameters required for running and building a successful startup. So areas where they are not strong, do they have enough support from the team members? Do they have equally capable and involved team members as a part of the team so that they can actually focus on all the areas and one person is not burdened with all these efforts. So that's where the discussion happens, especially when there is a single founder saying, okay, is this a person going to pull off this venture? So I think if we are able to get comfort on that front, nothing stops us from funding a single founder startup. And coming to the other part of your question on the overall team, again, there we look at, okay, how are the skill sets of all the people? Are they complementary? Are they supporting each other? Have they worked together in the past, or how do they gel well? Because early days, there are so many things which are going to be uncertain, unclear, and people need to take ownership. People need to be involved. So is it one person who is going to drive everything, or are there people uh, in respective teams who are able to take reasonably large decisions, and only key ones come to the founders, right? So that way, again, we look at it from the overall team. If they have the necessary skill sets, necessary connections to build the stuff. And yes, again, to answer your earlier question, IIT, IIM is, yeah, it's there. It helps people to get the initial connect within those circles, maybe. But end of the day, it's the business that we evaluate.
I'm going to do a very quick one question on this, on the team part, before we move on to the other things I want to talk about. So Shivangi, if I had to ask you to describe an ideal team which you would look to fund, right? What would the team have? And the same question to Jatin and Abhiram. So quick 1 or 2 line answers for, based on your experience and all the successes you guys have had. If I had to say, listen, describe to me an ideal team, right? Like a cricket team, 5 batsmen, wicket keeper, all-rounder, and 4 bowlers type of thing, right? What would you have?
So an ideal team, I think, MSR, is one where the founders have skin in the game. So, we tend to look at teams where both the founders, if there are 2 co-founders who are part-time, we are a little skeptical about it because we are not sure how committed they are to the company. So what we look for at the initial stage is how much skin in the game the founders have. We would prefer at our stage companies with more than one founder for the reasons that Abhiram has highlighted. In terms of the bandwidth of the founder, what he's going to focus on, increasingly what we're seeing is founders come and say that they're struggling with subsequent fundraisers because either they grow the business or raise money. So what we're seeing is that just a technical founder is not enough. So the team might be great, but if they lack the skills to raise money and to manage the business, it goes downhill very, very quickly, and which is quite not really the best outcome for everybody concerned. So I would say, and yes, founder pedigree, it's much abused and mixed with Ivy League pedigree. But when we say founder pedigree, it involves a lot of things, including the educational background, more importantly, experience in the sector, outside of the sector. What is it that's driving the founder to build the business that they're building, and how linked their story is to the business that they're building. Is their story going with the business, or they have a separate story going in their lives? So that's the factor that we look at apart from everything else that's been highlighted.
Thanks, Shivangi. Jatin.
So for us, the ideal, of course, we have exceptions on both sides, but for us, the ideal founding team is a 2 to 3 member team with complementary skill set. Because many times in the tech field, right, tech startups, what we find is either, the founders are tech heavy and they have a little bit less business or sales marketing sense. So I think most of our successful companies are either 2 or 3 founder company with complementary skill set, and they have a history of working together at least 4 or 5 years, be it in college or be it in that previous whatever they were doing, right? But complementary skill set is, I think, very important, so that there is a balance between product tech on one side, sales, marketing, operations, and hustling on the other side, which would help in, both scaling up as well as future fundraisers.
Abhiram, last
yeah, just to add a couple of things on top of what Shivangi and Jatin mentioned. So I think we also look for energy in the team, because end of the day, no one knows all the answers at the early stage when a venture is starting off, right? So things will work in your favor, things may not work in your favor. You will have to take detours. Sometimes you might have to pivot sometime, or you might actually hit 6 in the first option itself, right? So different things can happen. So it is necessary that the founding team has the energy, has the ability to think quickly, act quickly, and they're actually open to feedback and reviewing what is happening and course correcting where required. So I think that's one important thing which again institutional investors will look at.
Thanks. Great points, Shivangi, Jatin, and Abhiram. So I'll quickly move on to let's talk a little bit about what are the things you look for in the product offering or services offering or solution offering. When somebody is speaking to you, what are the, let's say if I were to ask you to give me a, let's say what is the secret sauce which you look for, 3-4 things from the product, solution, or services offering. So let's start with you, Abhiram, and then we'll go around the room again.
Sure. So I think what we try to understand is basically what are you changing from what is there today on the ground, right? Is this something new which is coming in? Is this something which is a marginal improvement, or is this a significant change of an existing product or offering in the market? I think that is going to be very important because as VC investors, marginal changes are not something which would be of great interest to us, right? Different people will have different investment focus areas. So maybe VCs are not the right guys for them to approach for funding, where they're looking at just marginal tweaks from an existing thing. Only where you're talking about a completely new solution being offered, or a very significant change from what is currently there in the market. So that is where I think there'll be more interest from VC kind of investors.
Jatin,
so
people talk about this thing called IP, right? So maybe we can cover that part a little bit.
Absolutely. So I think for us, important criteria besides what has already been covered is how innovative the solution and how much tech IP is in the solution and the product, and obviously how scalable it is. So in terms of tech IP, what we prefer is obviously, right, if you throw money and resource at any problem, you will be able to copy it eventually, right? So for most of our startups, they have a 18 to 24-month lead over competing products, especially when it involves deep tech and more innovative solutions on the tech IP side. And then we make sure when while evaluating the team that they have the capability of trying to maintain that edge and eventually with scale, etc., create that moat around it, right? So I think that is very critical as a deep tech fund for us. And like I mentioned earlier, we prefer recurring revenue models in tech rather than a one-time license selling and then AMC. Again, but there are exceptions even in our portfolio. Yeah, but that's the preferred model.
Thanks, Jatin. So Shivangi, sorry, I think I'm asking you all the consumer-led questions.
So I mean, to be fair,
these two gentlemen are really more on the tech side.
So our
from the
portfolio
consumer
actually
perspective, what do you
had
look
a
for
very
when
deep
somebody
tech
comes with a consumer
focus.
idea?
Consumer, I think, as Viram also mentioned, I think it's very important that the idea is very clear on whether it's a disruptor or a differentiator, because the way the two models will be scaled are very, very different. And there is a certain set of investors who would like to invest in a differentiator, provided that it is a significant differentiating aspect from the competition. So as a portfolio, we've invested in both disruptors and differentiators. So that's one aspect. I think the second aspect is the defensibility, because especially when it comes to consumer companies, how defensible your product idea is. Because again, as Jatin rightly said, there might not be much of a lead time to competition coming in, especially in the consumer space. It's very, very easy to replicate. Chances are that the investee company that we are looking at also is a copy from somewhere. It's just that they've done a better job, and hence they are where they are. So it's very, very important that these three factors fall into place. And I think the defensibility is key, and an understanding of where you are standing vis-a-vis the competitive landscape. What we've seen is the founders who have a very clear understanding of where they are placed in the competitive landscape are the ones who are able to navigate it better. Those who believe that there is no competition and they are the only players in the market, that is where the challenges start, because they're not willing to look current vision is what I would say.
Thanks. I think Shivangi, that's a good segue into my next question to, and this time I'll start with you, Jatin, was on what do you look for from the, let's say, from the entrepreneur in terms of understanding of the competitive landscape and so on, and competitive advantage. What are the, let's say, if I were to again ask you to prescribe the 3 magic mantras, if you will, right? What would they be?
I lost you in between for 4-5 seconds, but I think your question was around how to look at, in terms of the founders, how he looks at
from a
competition,
competitive
right?
advantage standpoint, competitive understanding of the competition landscape,
Yes.
and competitive advantage standpoint.
Sure. So I think the first thing is obviously the founders should be aware of what competition there is that exists. Sometimes we have received startup pitches where the founder is not even aware that there is already tons of competition out there, right? So I think the first thing is there should be awareness of what the competitive landscape is. Second is there should be some mapping also done, right, for investors when they are pitching in terms of how they are better than the competition out there. So that gives a good sense, in a single slide to potential investors as to how they stand on the competitive landscape. And third is obviously assuming that they are ahead in some of these either features or in terms of tech or in terms of innovation. How will they continue to maintain that edge over competition, right? So I think these are the 3 things broadly we would look for in terms of the competitive analysis.
Thanks, Jatin. And I'm going to just quickly segue to Abhiram. Abhiram, people talk about product roadmaps and all of that, right? Building on what Jatin said. So tell us about what level of depth do you look for in the roadmap? Just talk us through the roadmap part.
Sure. I think we look at it, say, in a immediate term or a near term, medium term, and longer term vision. I think we broadly look at it across these 3 buckets. Immediate term is where we are trying to understand from where the company is today. Where is it planning to go in the next 3 months, 6 months, post this funding event where they'll get more amount to invest and build a faster, higher team, etc., right? So how are they planning to progress for the next 3 to 6 months? Then medium term, say in the next 12 to 18 months, where would they be? Whether it's in terms of product features, whether it's in terms of offerings within the product, in terms of any partnerships, in terms of go-to-market, how many customers are they planning to look at, what channels would they be exploring, and then finally the longer-term vision, which could be, say, 2 years, 3 years down the line. And there I would want to again call it out that here, while people do put their estimation in terms of where they could reach, and these days, I think many people we've been seeing saying, "Oh, in 3 years, I'll be a unicorn." I think that's become a very common vision statement in the pitch decks, right? So it's less. No one knows what will happen in that 3-year time period, and lots of things will change and evolve. But these are required for us to understand how the founders and the founding team is looking at building this company, and is it something we have enough comfort with in terms of how they're planning to build this business, and do we have enough confidence in terms of how they are thinking about this, and would they be able, have they considered all the aspects in terms of building this business, and what kind of flexibility do they have if something doesn't work out? Do they have those scenarios thought out, saying, hey, these are the experiments we are planning, and this is how we think it will move. But if A doesn't work out, B works out, then maybe we can explore this option. So obviously we'll have the going in hypothesis, but we should have the flexibility to even be ready to change and adapt as things evolve.
Thanks, sir. I have a lot of follow-up questions, but in the interest of time, moving on. So Shivangi, I'll start with you now. I think there are 2 aspects which I want to cover very quickly. So one is all this about customer engagement and traction, right? That's one part I want to talk to the 3 of you about. And the second is this whole thing about how do you make money, which is obviously a critical question, which I'm sure you'll ask. every potential investment, investment you're looking to make. So let's talk a little bit about this customer engagement, the metrics, and the growth and marketing plans. We are running a little short of time, so let's do this quickly. So let's start with the customer engagement and metrics. What are the things you look for?
So I think customer engagement, one thing is the growth rate of your customer onboarding. That's very, very important because in an early stage, you might not start with a very large base. But what is the month-on-month growth? Because at this stage, year-on-year is a bit of a myth. So what we look at is the month-on-month growth rate, how the business has been able to attract eyeballs. The second is a retention rate because it's okay to have a first-time customer or a first-time download. But how successful are you in retaining that customer? A third very, very important metric I would say is customer acquisition cost. I will not put a number here because it's different for different sectors and it unnecessarily sets incorrect benchmarks. But that's very, very important that your costs are in line with industry benchmarks for whatever sector you are in. If they are not in line, there has to be a very, very good explanation behind why it is not. And how is it going to impact your cash flows in the future? So this whole piece on customer engagement, I think these are the three key metrics that we look at if there is a consumer-focused company.
Thanks, Shivangi. Jatin, from a B2B perspective, what is it that you look for in an early stage company? From a customer engagement, and what are the typical, you talked about SaaS, so I'm sure there are a bunch of metrics which you can put.
Correct. So I think within SaaS, there is the entire alphabet soup of abbreviation metrics. But I think just covering quickly the 2 or 3 important ones, right? Of course, there are many others. Obviously, one is the basic one is MRR, ARR, which is a monthly and annual recurring revenue run rate. And then there is net revenue retention, right? That's very important, right? If you are churning, losing customers faster than you are gaining, or you are not able to land and expand in an existing enterprise customers, business, then obviously your net revenue retention will not be as high as what investors would look for, right? And then, of course, many companies have large contracted ACV, is what we call it, the annual contracted value. But conversion from ACV to ARR or MRR, typically we see a very big gap. So that gap should be as less as possible, right? Hopefully 3 to 4 months. So I think that's an important metrics. Outside of that, there is a whole lot of other things from LTV to all of these things, right? Which I'll skip in the interest of time.
Aviram, you'd like to add? I'm sure there's a bunch of things you'd like to add, but yeah. From a customer engagement and metrics, anything you'd like to add to what Jatin and Shivangi just said?
No, I think, of course, there are multiple things, right from gross margin percentage, how much are you doing it, what kind of your revenue is coming from organic versus distribution. Partners, customers who are coming onto your platform, how long are they staying on your platform, renewal rates, how many are actually dropping off and how many are then coming back. That explains your efforts in terms of attracting drop-offs as well. It's relatively easier in many circumstances to get your past consumers versus completely new users, right? So that way, yes, there are, and again, once you go into the specific business model of that company, then there'll be far more nuanced metrics which are specific to that product as such.
So Jatin, one quick question on this about customer concentration. Or, for example, sometimes I think people think that, if you're selling to the government, there's this perception with a lot of entrepreneurs that typically VCs are not particularly keen on businesses which are heavily focused on selling to government. So if you could just quickly clear the air on the customer concentration as well as the selling to government kind of thing.
Sure. So I think the customer concentration, we look at it in 2 ways. One is the qualitative, which is what you are referring to, and another is the quantitative one. So as you rightly said, I think funds are somewhat uncomfortable with huge concentration of purely government or purely defense or purely PSU client base, right? I think as long as it's diversified and it happens to be one of the sectors they're catering to, that is fine. Of course, as the ecosystem matures, I think that may change. So that's the qualitative aspect of it. On the quantitative side, sometimes you find, right, 95% of revenue is coming from a single customer. It's okay in very, very early stages, right? But I think broadly at somewhat, let's say at a Series A stage, ideally, right, from your top 5 customers, or at least your individually top 5 customers, should not be more than like 10-20% each, right? Because that then otherwise be very, very concentrated revenue. If that client folds or does not renew the contract, you're dead, right? So I think those are the two things.
Okay, so we're almost running out of time, but I wish we probably should have budgeted some 4 hours for this, but anyway. So let's quickly, so I'll start with you, Abhiram. From the financial standpoint, right, high level, what are the, what would you like to see, right? When people present, then I guess people present these hockey stick graphs, type of thing, right? What do you generally like to see from a financial at an early stage?
Yeah, early stage, I think the key focus is in terms of how is your customer traction and what kind of revenues are you able to generate from those people, and what are the key costs that you would be incurring, whether in terms of team or technology or customer acquisition costs, etc. Of course, we can't expect profitability in the early days of it, but we'll definitely try to get a sense of do these people understand how the numbers work for this business in terms of revenues and expenses or capex, and then try to see is there any scope, how would these actually evolve and get optimized as the company scales or the offerings mature, right? So I think it's more from that angle. P&L, the profitability as such comes up maybe a couple of series down the line, series A, B onwards, where companies might have profitability or they might already have a clear path to profitability. But in the early stage, I think a greater focus is in terms of the problem it is solving and the kind of market it can get, and what are the initial numbers looking like from a pricing perspective. Where can you price it? How much would it cost for you to manufacture that product, etc.
Sure. Thanks, Abhiram. So we're almost out of time, and there's, I think, obviously there are a bunch of other questions, but I'll quickly go around the room, right? And this is the question which I think most early stage founders struggle with, which is, I want to give up 20% and I want to get valued at $1 billion, right? That is thing, right? So now the question is, and Shivangi, this is for you and for Jatin, and I'll come back to Abhiram as well. What fundamentally, I guess, how would you want that to be articulated? I think it's fundamentally about how much money is required to scale and grow the business, and valuation lies in the eyes of the beholder, right? So from that standpoint, how do you respond to when I've heard founders come up to me and say, listen, I want to raise 1 crore and I want to give up 5% of the company, right? For a company which is doing, let's say, a couple of lakhs of monthly run rate. So typically, what's the right way for the founder to articulate this?
Couple of things can be considered. I think at the very, very early stage, if there is not much of a steady, say, monthly revenue coming in, or maybe not even a clear revenue recognition policy, what might work for the founders is to do a non-price round, which is to do it at a discount matrix to the next price round. That works in cases where you're not able to tangibly peg a value to the company because there are multiple factors in play which have not yet unfolded. So we see this a lot, especially when tech is involved, where there is a disagreement between the investors and the founders in terms of what the value of the company should be. But outside of that, I think since there are no technical methodologies on which one can value an early stage company, and I wouldn't recommend anybody try and do that because most would fail and lead to very incorrect assumptions. One, I think the benchmarking to the market in terms of what valuation peers have raised, that what is a multiple that is current revenue multiple that is currently floating in the market, because one would assume that unless it's a deep company with a patent, there would be some revenue numbers that one can look at or that one can benchmark against. So these are the 2 or 3. And the third is that an investor will come in at this stage only when there is something on the table for the investor. So if you've actually realized the full value of the company, then there's nothing really that's that attractive to an early stage investor. So then you must also decide what is the value that you're willing to leave on the table for the investor to come, so that when they come into this asset class, they're looking at a 30% IRR on an average. So any financial investor who's taking that risk and coming to invest in an early stage company is coming to make that 30% IRR and above. I think founders need to be cognizant of this fact when reaching out to any financial investor, whether it is a platform such as ours or one of the VC funds. I think that aspect is kind of forgotten about, and the early stage investors to be altruistic in nature, which is not true. So we also have certain financial goals to achieve, and the ideal deal is struck at a balance of this when all stakeholder interests are taken care of.
Jatin, Nabina?
Yes, I think at the early stage, it's not just maths, right? There's also art and gut, right? So art is the art of negotiations on both sides, right? The gut feel is obviously a little bit more investor specific based on some of the parameters that Shivangi mentioned, right? So I think it's just that. So, and also obviously it is also determined by the markets, right? These valuations and dilution levels were very different when we started Fund 1 versus where we are today. And I'm sure what Abhiram and Shivangi will agree. So I think it's also a function of the market, and how confident or how much conviction you are with which you are able to sell to the investor that this is the right valuation for the company.
Thank you. Abhiram, you'll have the last word on this.
Yeah, so I think both of them have covered most of the points. I just add one more, saying in case the founder is not getting the quantum that they want, or they are required to do a higher dilution than what they had planned for, then one way they can look at it is actually split it, saying I wanted 10 crores, but I'm not getting demand from investors for that 10 crores. So maybe I will take 4 crores, which I'm getting today. And instead of raising the next round after 18 months, I might do it after 9 months or 1 year. But at least I will take that 4 crores, progress on this journey. And at that point, at a higher valuation, I'll be able to raise. So that's one angle of looking at it. Of course, if they are getting a lot more demand, then instead of diluting 20%, they might dilute 15% for double down. So that option is also there. So end of the day, I think Jatin summarized it well.
Okay, one last question before we close this. Once, let's assume the founder has listened to everything the 3 wise people on this panel have given them, and they come together with a good pitch deck and they present it to you. What is the preferred way they should follow? Should they, spam you with 1 million mails a day, or what is the general, what would you suggest? What seems to work, for example, at your fund? What's the preferred way for the founder to keep in touch with you? And suppose you say no, is there how should they keep you updated about what's going on in the company? Because a no once doesn't mean a no forever, right? So let's start with you, Jatin, on that.
Sure. So I think, the channel through which they came in is generally the channel through which they would follow up, right? And what we do formally is, as you rightly said, right, once no doesn't mean permanent no. So we actually shortlist a few startups to be on the watch list, right? So that's a more formal process for us where our internal team will also follow up, right? And then outside of that, if suppose we have not marked a startup as being on our watch list, if there is any significant development, right, we expect, them to kind of get back to us, with the old thread saying, hey, this was the feedback last time and this is the progress we have made, and would you be willing to look at it again? And we have had such reconnects, right? And ultimately some of them have ended up being our portfolio company. So it's a very valid thing to do. And I think founders should be very tenacious, in terms of some of these things.
Abhiram and Shivangi?
I think one other practice which I've seen many founders do is, even if discussion hasn't fructified now, they keep updating. If they like us and based on the discussion, it's not a complete no, even for the future, then they keep sending these mailers to all those prospective investors they have in mind, giving updates on their business. It doesn't talk about funding. It just talks about their progress, what new things they have done, what's been their traction, etc. Of course, they need to balance it out in terms of how much information they want to disclose it, because these are emails which are going out as such. But there are quite a few companies who do share that, and people do get back. And like Jatin said, we do have companies who are in a watch list, and we do review all these email updates, and at the right time we might ourselves also go to them and say, hey, are you looking at funding anytime soon, and let's catch up. So that also happens.
Thanks. Shivangi, the last word on this.
I think the best way to do it, to reach out to Mumbai Angels, is to write to anybody in the team. We are very, very responsive. We have a very structured process in terms of deal evaluation. Every deal that hits any of our inboxes is evaluated. We may or may not have the bandwidth to respond to the founder, but given the volume that we deal with, about 10,000 companies in a year at a minimum, that's maybe a bit of a stretch to give feedback to everybody, but we evaluate every company. And as Jatin and Abhiram mentioned, we do add some companies to our watch list if we think it's a little too early for us. And we let the founders know that they can stay in touch with us and keep us updated from time to time. In terms of the frequency of the update, I think maybe 6 months is a good time frame, because if we've asked the founders to connect in some time, then they would probably need about 6 months to have any significant update. So we've seen founders being very proactive and reach out to us, saying that, hey, you asked me to get back in touch and this is the newest update. And yes, they don't mention funding, and that's a point at which we reach out to them and ask them, take the conversation forward. So it's a bit of a two-way street. We track companies that we think have potential. Founders reach out to us. So in the case of Mumbai Angels, we would actually request the founders to reach out to us with the context mail, because it makes it easier given our team size and the volume that we deal with. Otherwise, it may get lost, and we wouldn't want it to get lost. Let's put it like that.
Thank you. Okay, so I think sadly we've come to the end of time for the panel. Thank you, Shivangi, Jatin, and Abhiram. I think we could easily convert this into a hackathon for 24 hours, and we still have questions. But in the interest of time, we have to move on. So thank you very much. I think there are, I think there's a whole bunch of questions. So what we'll do is we'll collate all the questions when we can, and then share them with you, and we'll figure out a mechanism to go back. I think there are a lot of very specific questions on, for example, if I'm building a social media app and I won't have traction in the beginning, things like that. We'll come back. We will put together a curated list of questions, and I'm going to take the liberty of seeking your time after that to be able to respond to some of them. Right. So thank you very much. It's been a real pleasure talking to all of you, and I do hope the audience has benefited from your insights and success. So we'll move on to the next part, which is the the pitches, and basically the idea is that the founders will do short pitches, and we'd really want the three panelists to kind of do a quick analysis of what they liked from what they heard, and also what are the things they would have liked to see further develop, to get the pitch to a level of refinement. I think Mansi and will take over now. So we have Nikhil from Roadmetrics, who's up first. So Nikhil is the founder and CEO of Roadmetrics. So Nikhil, you met the panelists, so and you know you have 3 minutes. So over to you.
Great. I hope everyone can hear me. All good. Yeah.
Yes, we can.
Great.
Speak up a
I'll
little.
just share. Yeah. I'll just share my screen. Just give me a second. Hope everyone can see the blue screen that I'm sharing. Yeah. Can everyone see the blue screen that I'm sharing?
Yes, we can.
Okay, great. All right. Hi, my name is Nikhil. I'm one of the co-founders at Roadmetrics, where we provide AI-based road assessments. The main problem that we're trying to solve with Roadmetrics is that road inspections are usually manually done as of now, and usually councils and city authorities, road maintenance teams use a very cumbersome process of road inspections. And our solution is using AI to identify road defects and automate this process of identification of road condition defects. The system that we've come up with is very simple. All you have to do is simply mount the smartphone above the dashboard of your car. We have a data collection app where you can upload the video recording, and we capture the video. We capture the GPS coordinates, the video data, and provide a quick road assessment for the authorities. Once the assessment is done for road network, you have RoadMetrics Enterprise, the dashboard platform, which helps the road maintenance teams to visualize the whole city or a whole road network in a bird's eye view, which has a section wise road analysis as well as access to image points with GPS data. In terms of what we identify on our AI model, we identify early stage defects like transverse and longitudinal cracking, asphalt traveling, minor to severe potholes and alligator cracks. This again goes on the preventive and reactive maintenance aspect of road maintenance services. The third part of our solution is that we have a RoadMetrics Utilities app, which allows the road maintenance teams to upload the data once the road maintenance work is complete, and this gives the authorities a complete tracking and history of all the road maintenance related activities that are done. And just to kind of summarize what our product does is our AI-based road assessment service helps with prioritizing the maintenance action plans with high resolution image points that comes with a file level road assessment with PCI. It's an international standard for road condition index. Yeah. The way we kind of work with our customers is that we provide road assessment services based on a per kilometer or a per mile basis. For our customers, it includes the assessments, the asset information, and an evaluation in less than 2 weeks. That's the way we work with it. And in terms of how we're gearing up towards in the international market, we have robotics and Vialytics, both US and German based. While they provide road assessment conditions, we provide road assets, the dedicated utilities app, which gives an end-to-end solution and at a highly competitive pricing as compared to our competitors. As of now, RoadMetrics is working with two major customers, the Tata Group with the city of Jamshedpur. We had a pilot project with them, and now it's an annual contract with them so far. Electronic City in Bangalore, which is again a private township, and we also have a presence in the UK. We have just recently expanded to the UK and have ongoing pilots and multiple tenders with counties and city authorities in the UK. And one of our recent bigger engagements has been the defense pilot with the Border Roads organization, where we had a successful pilot, and we are ongoing discussions for the 28,000 kilometer road network, which is currently ongoing. In terms of our recognition and awards, we've been grateful to have been recognized one of the top 3 AI startups at the Atmanirbhar AI initiative by the Government of India, the Race 2020, and also the top 50 startups at Slingshot, which is hosted by the Singapore government. We've also been backed by 100x.vc.
You have 30 seconds.
So yeah, backed by 100x.vc, Black Soil Capital, and T-Hub as well. Our management team, so my co-founders, Dipin and Mishal, are computer science graduates from Gujarat Technological University. I previously worked in the automotive and mapping space in the Silicon Valley with Tesla and Velodyne LiDAR. So our company, we've got offices in London and in Bangalore. And we're actually looking to raise Series A round, which will help us scale up with the sales team in the UK and in India as well. So this is our pitch. Hope look forward to hearing your questions.
Thanks, Nikhil. Sure. So we can again do this quickly. Quick feedback. We'll start with Jatin and Abhiram, and then Shivangi.
Sure. Yeah.
Any questions?
Yeah,
what
just
do you like?
couple of quick questions. Right. One is, what's your revenue model? Right. Quickly.
Yeah. So the way so for example, I'll give you our customer, that's the Tata Group. They have a 500 kilometer road network, city of Jamshedpur. So they've signed an annual contract with us, which we charge them on a per kilometer basis at a pricing that we discuss with them. So that is kind of how we do it. We have either say quarterly surveys or 2 surveys. It depends on their own schedule. So that's how we started with our first contract. Now we're going to be renewing it in continuous assessments with Tata. Similarly with Electronic City, and in the UK we have tenders where they have contract sizes between say 100k to 500k in pounds, and it's a 4-year contract. So that's kind of how they do assessments on a per mile basis. So that's our business model.
And the road mapping you do by crowdsourcing or
no. So the system that we have, right? It's a simple smartphone. What we do is we provide the data collection kit to the authorities. So they have their own survey cars. Usually, say in the UK, giving an example of UK, they have it's a mandate for that. The government has a mandate that every 3 months there has to be an inspection made for the entire road network, or say 6 months. So based on that, they have their own survey teams. All they have to do now is fit a smartphone on the above the dashboard, collect the data as they go across, and we do an instant evaluation. So it's all done remotely. The survey is done by them.
Sure. So I'll have Abhiram and Shivangi if they have questions before we give the feedback, I guess.
Sure.
Thanks, Nikhil. Just a couple of quick questions. So, is the product fully live? I saw your comparative slide. What is currently available? What is the roadmap for the future? And second portion is you seem to be looking at London office. So, at this point, do you have any teams there, or do you plan to build a team there?
Yeah. So we, our office is in London as of now. So I've been traveling back and forth the last 6 to 8 months. We are looking to build a team because we've got a lot of engagements with them, like demos, pilots going on with private contractors, county councils, and so on. So having a sales team is very crucial for us because that helps close the deals. And these are big ticket deals that go on. So usually last tender we were there is about 1.2 million in pounds. So that kind of gives a 4-year contract, and once we're able to close it, that helps. So yeah, we are building a team in London. As of now, we have in India, in Bangalore. So that's kind of our goal there. So the first question you asked was the product, right? So the product is quite mature. So we've iterated over a long period of time. It's about a 1-year cycle where we've got feedback from our customers. That's Tata. We've got a lot of feedback. So we've built this based on the customer feedback that we've received. A lot of new classifications like broken signages, trees that are fallen apart. So a lot of the things that are actually required in terms of a maintenance perspective. So the product as of now is very mature. We have 3 offerings. That is the data collection app. You do the survey, collect the data. The enterprise application, which is the platform that I'm showing right now, which helps with all of the reporting tools, prioritization charts, and so on. And the third one is the utilities app. So once they do the work, the contractor does the work, they upload the image of the roadwork that's complete, and the administrator has a complete analytical kind of a tool for them to see all the historical road maintenance efforts. So yeah, these are hopefully I answered your question.
Just a couple of questions, Nikhil. One is that what is the underlying technology that you're using for this mapping? I understand that is installed on a Star smartphone, but what is the underlying technology? And also, is your mapping linked to Google Maps?
No. Yeah, so our technology works on, so it's AI. We use a computer vision mask RCN model. It's based on AI. So if I'll just give you an example of how this works. So now when you have a visual manual assessment done by the survey, the teams, it's just a human seeing all of that, right? So now what we've done is we've trained this, taking the video data, we extract the image points. Now, what the human would see, we try to, replicate that on the model. So if it's a defect of a pothole or a raveling or, say a crack. So we trained that with over 10,000 kilometers of data. So it's quite, accurate as of now, but 95% accuracy. So we run the model first, get the results from the system. The rest of the 5%, we do a manual filtering process. So our customers get 100% accuracy with all the defects. So it's based on AI, computer vision. So we've trained this. Our IP is based on models. So we have an India model, UK model, a US model, and so on. So that's how the proprietary AI model works. So Google, we're not, as of now, we're not collaborating with them, but they've asked us to keep in touch, and we've actually reached out to them, asked us to keep in touch as our model matures, and that's something which they want to use in the Indian market to have a better mapping experience. So, yeah.
Thank you.
Thanks, Nikhil. Sorry, I'll have to cut you off.
Sure.
We can do an offline thing. One quick one line each from Jatin, Shivangi, and Abhiram on what you liked about what you heard from Nikhil, and what would you like to know a little bit more about. So let's start with you, Abhiram.
Yeah, I think a bit more on the team side. Right now, we just have it in a very short space. So more on the team and more in terms of how big is the opportunity here? How many people? What are the various use cases? How much of revenue could you generate from that?
Jatin?
Yeah, I think, your articulation and the pitch was crisp and good. I think the problem you're trying to solve is interesting. The only sort of, feedback would be, is this, how large is the market? Is it scalable, right? One is that. And second is, There's a lot of computer vision AI-based companies, right, solving many problems, right, and it is very fragmented startups. So kind of like in your case, right, they are solving one or two problems. Now, with maturity of the computer vision market, we are seeing some companies doing a platform approach and a marketplace of apps. So for example, right, you would be a participant on those marketplace of apps and operating system of CV, right? So that's a bit, just keep in mind, right, about that, I think. Yeah.
Shivangi?
So in terms of the pitch, it was, I think, as highlighted by Abhiram and Jatin, a great pitch, very well articulated. A couple of things on your slide deck. One is that in terms of the revenue model, if one can highlight it a little better, that's not clear. And the second is the customer adoption, because how would you ensure customer adoption is a key point that maybe you can look at highlighting.
Thank you. Thanks, Nikhil. Thanks, Jatin, Abhiram, and Shivangi. Next up, we have Todd, and we'll have Josh.
Hi, all. Give me a second. 1 second.
George, I'm about to say your time starts now.
All right. Hi, all. I'm Georgie. I'm a second-time founder and the CEO at Tot Academy. We are an online extracurricular platform for kids in the ages 5 to 15. Here, we want to act on 3 specific points. One is to bring in accessibility for kids, then convenience, and to disrupt the traditional method followed by the existing industry. So before starting this particular company, we spoke to multiple parents understanding their different pain points. And what we have primarily identified is this particular market is highly fragmented, is controlled by local institutes as well as teachers, which are following an unstructured learning process, which are not fitting to the demands of the current age kids. So here, what we are trying to build is a curated online hybrid learning model, wherein we combine online live tutoring, helping the kids in terms of getting personalized attention. Along with that, we give them interactive and animated course materials prepared by celebrity experts, helping the kids in terms of concept revisions and practice. Now, while defining this particular solution, what we've identified is for any of us to learn a skill, we have to do 2 things. One is to have a structured learning, and second, we have to revise and practice. And that is where kids find it difficult to do so. And this is where we want to chime in, help them out, and bringing an interesting revisioning and practicing sessions with them. So that is the solution that we have currently built. So we initially launched the platform with a 1 course that is in hip hop dance beginners, partnering with 2 movie choreographers. We launched it in the month of July 2021. So they will help us in preparing the curriculum as well as the video materials for revisioning and practice. And apart from that, we have a tutor bunch who will be taking the live session for us. So currently speaking, we have 4 courses in hip hop dance, painting, doodling, as well as piano. Now, what is the bigger picture that Tot want to paint with our platform? So initially, we are helping those passionate kids, helping them to become masters of the specific skill. And we believe a bunch of them will ultimately become creators of the specific field. Maybe a good writer can be a good author, a good singer can be a musician. And we want to help them with providing the right opportunity. And we are having a couple more elements that we are building in terms of our portfolio, as well as some earning opportunities that we are currently building with our mobile application. So ultimately, we want to create a kids creator ecosystem with Tot as a platform. So on the edtech market size, it's a pretty huge globally. And a recent survey by IIM Calicut shows that the Indian extracurricular market is valued at around $5.8 billion US. And we want to capture around $80 million US. And currently, through word of mouth only, we have customers from 8 different countries. And currently, our main market position is in India. So a couple of our key metrics. So currently we have touched almost around 9 lakhs in top line revenues since the past 8 months in operations, with which we have around 2,300 registered students on the platform, of which around 261 are paid users on the platform. We are around 27% in referral sales and 31% converts as from our potential demo session to conversion. So now we have closed a friends and family round of almost around 82.5 lakhs with CCD during the month of March 2021. Currently, we are seeking for a pre-seed round of 1.2 crores INR for a 6 months runway. Specifically, that will be going into the marketing as well as sales, and we want to improve our top line revenues. That is the aim for this. So our plan for next year, we want to hit around 2.5 crores in top line revenue. And for that, we require around 1.4 lakh user base. And with a 3% conversion, we need to get around 4,167 users. Couple of the GTMs are, we are launching a mobile application and we are building a content strategy called as value bundle, where we'll be channeling users from social media's short video contents right to the mobile application, and then doing a campaign on that. So that is the primary objective that we are planning, or GTM that we are planning for this year. We both are the founders. I am the business founder, Another is a product founder. I have a previous exit from my previous company called Servantire. I started my career with Byju's, and also I was a part of an NGO with my teaching experience. Another is having a complementary skill set. He is from technology as well as media background, started his company, media company initially, and then came on board with me during my previous company. He handles the media as well as technology. That is a core strength of Tata. That is in terms of our presentation. Thank you for the opportunity.
Thanks, George. Thanks, George. Okay, so Shivangi, you can go first, and then we'll have Jatin.
So I think 2 or 3 questions, Georgie. I'll keep them crisp. So one is that I wanted to understand how would you ensure content quality and consistency, because there's multiple tutors across the platform. The second is, I'll just highlight all the questions. The second is your revenue model. Also, is it a percentage fee that you're charging from the tutors? How will it work in the long run? And also, what differentiates you from the other players in the market, be it Kite, Bambino, Domestica? I think right now there is a flood of such companies that come. In fact, if I were to look at it, I think I have about 2 or 3 companies in our pipeline also, which have not pitched yet. So these are the questions that come straight off the top of my head.
Sure. So in terms of the content, we have an in-house content team. So we get the content creator in, I mean the influencer or celebrity, and we have this content created in-house. So that is how we have the quality. So I can confidently say that our content is at par with the quality of DIY or any other platform is creating. So our differentiator is some only do content, some only do live tutoring. So we have combined both this. Why? Because we had an understanding that kids need to get the live learning. Also, they need to revise and practice. So the short content that we have created helps in the revisioning and practicing. The personalized attention comes with the live tutoring. Now, on the video material, also we have built a storyline along with the animated character who will be interacting with the specific influencer in bringing an enhanced experience while learning. So that is in terms of that. Now on the revenue model, so we currently sell on courses. So as I mentioned, we have 4 courses on the platform. Those are beginner level courses. Currently almost around 2 months in the customer lifetime. So we'll be increasing that with intermediate and advanced programs. That is in terms of that. On the revenue share, so I mentioned that there is a gig economy of tutors who is handling our live tutoring. So we give a share of almost around 35% for the live tutors who are on the platform. They are on contract basis with us. Thank you.
Thank you.
So this is a pure B2C model, right? So you have to get traffic to your website, or
we are purely B2C, yes. But to increase our top line revenues, we are also talking to a couple of schools for a bulk purchases. So one, we were successful, but again, it takes some time to get them convinced and get them on board. But we can surely increase our top line. So we are also looking at that for the next quarter, if we can scale up on that. On November, we closed a 50-unit sale from a school, and this month also we are planning to do one more sale. So that is also something that is in the back of my mind.
Correct, because pure B2C, right, you'll require a lot more funding as you grow. So I guess, yeah. And the other quick question is are these one-on-one sessions or are these group?
Yeah,
is it interactive, or this is just one group and you go through the class, or is it?
There are 2 programs. One is a one-to-one personalized model. So in terms of technology, we are not taking sessions on Zoom or Google Meet. We have created our own interactive live classroom. We call it as Fun Room. It's a trademark platform for us. So that is where the classes happen. Now there are 2 options. One is a one-to-one personalized learning. family. Along with that, the kits also have a 1 to 4 group option. So most of our sales currently come in with the group option because the personalized is a bit expensive currently. The pricing ranges from almost around 5,000 rupees to almost around 12,000 rupees in between.
Sure. Yeah. Over to Abhiram. Yeah.
Thanks, George. A couple of quick questions. How has been your customer traction? How long have your oldest customers been? Any drop-offs? What have been your learnings there? And any new products that you're planning to launch?
Yeah, right. So in terms of the customers, so I mentioned that the customer lifetime currently is shorter because we have not launched the intermediate and advanced courses, because currently all the 4 courses that we have, there's 2 months program, almost 1.5 to 2 months program. So what happens currently is customers who have purchased our first course maybe goes to, say, for example, a kid has purchased painting, also try out our doodling course and so on. So that is in terms of that. The second question in terms of the future courses that we are building. So we all know that the market or the schools are opening up by the month of July and August. We have to accept that. So our plan for that is basically create niche programs that are not available on the local institute on a 10-kilometer radius. So we stand unique as an extracurricular platform. I can give examples. Say for example, money management for kids, or say for example, small music production, content creation. So these are a couple of courses. Also maybe fitness and those kind of courses is what we are planned for the next year, so that we become relevant in the field of extracurriculars.
So let's just do a quick go around the table. Abhiram, Jatin, and Shivangi, feedback on the deck. What you like, what would you like to see more of?
I like the energy in the deck. It looks pretty attractive in a sense, visually. Couple of points that you should look at including is, because this is a very B2C focused one, is more data in terms of how you're sourcing your customers and your customer metrics. I think that is one area where you will have to cover more.
Sure. I think from my perspective, obviously good crisp articulation and obviously a good problem that you're trying to solve. I think because you will be competing with, there's a lot of, while I didn't check it, I'm sure if I go to YouTube and I type doodling lesson or piano lessons, of course, I'm sure I'll find many such free courses also. So you're also competing with that, and also you have to attract traffic to your website and figure out a model where growth can be non-linear, right? Because if you start having one-on-one classes and all that, right, as you scale, you'll need so many people, right, that you have to deal with. Plus, you will compete with also the gig economy websites, right? Those Fivers of the world for this, I guess. Yeah.
I think in terms of presentation, it was fine, but I think a lot of key metrics are missing. Customer metrics, unit economics. How is the revenue model actually going to work for you? I think these things also need to be covered up front. Also, the scalability aspect of it needs to be highlighted. Maybe some projections, etc., need to come on your deck.
And just quickly, one more feedback. I think, you said you were looking for 6 months runway, right? You are already a one-time successful entrepreneur. That's very, very tricky. You'll have to focus on business, or otherwise you'll have to be constantly fundraising, right?
Fundraising, yeah.
Institutional fundraising, you have to at least give 4 months, if not more, right? From day one to the money transfer, for example. Yeah.
Actually, that's a fair point. 6 months is when we advise our portfolio companies to start looking for funds. So I think maybe asking for a slightly more than 12 to 18 months kind of runway might be advisable, especially in the current scenario, because there is still a lot of uncertainty, be it COVID. Now, be it with the recent war, there are a lot of factors that you might not be able to predict.
Thanks. I think that's great feedback. That's in Shivangi and Abhiram. Okay. Next up, we have Parkour Life, and we have Vijay. Vijay, are you there?
Vijay, please accept the panel request.
Just a request to the panelists. Are you okay? We looks like we may run a little over time. I hope you can give us a few more minutes, about 10 minutes more. Abhiram, Jatin.
10 minutes is okay.
Yeah,
10 minutes
I'm okay till 4:45. Yeah, I'm okay.
Same. I've scheduled something for 4:45, so I think 10-15 minutes is fine.
Thank you. Thank you, and I don't want to impose on you any further. Okay.
Not a problem.
Vijay,
Am I audible?
you can start.
Hi.
Yes, we can hear you.
The year was 2018 May. I was part of the Facebook India Acceleration Program at T-Hub, and I received a report one afternoon which spoke about an infertility diagnosis, and I was actually at the T-Hub premise. I had stress and anxiety-induced erectile dysfunction and sperm count-related disorder. It shook me. It was a little traumatic. I took a break from my work. I was running a company back then. I took a break from my work and I did a biohacking project, which led me to creating therapeutic intervention, which I used on myself. And within 3.5 months, I took my sperm count from 3 million to 51 million. That became the genesis of what we could today call as Parkour Life. Whenever there is a chronic medical condition, it is always accompanied by comorbidities like stress, anxiety, depression, and many such conditions, which is not addressed by medical conditions. And that is what we are set out to solve as a problem. And the platform that we have been developing uniquely detects the stress, anxiety, grief, depression, and other conditions through a multimodal diagnostic approach, and also has a multisensory therapeutic intervention, which ensures that what has been diagnosed can be addressed. While what we are creating can be used for any segment, I chose to work in the infertility segment because I have been affected by this, and I've also worked in the space for a very long time. We have developed applications using which we have helped thousands of people have baby as part of my previous venture, unfortunately, which was not successful. But coming to the domestic market, we have 5.5 crore infertile couple in India, out of which about 2 crore of them can afford to spend money. And we are targeting a very specific audience of dinky urban couple in India who are largely in the tech sector. That's about a 20 lakh population we are targeting to address. The solution that we are building comprises of cognitive care, emotional health care, relationship and social care, and behavioral health care. And there is published evidence that when you go through fertility treatment, you have only about 20 to 25% chance of taking home a baby. But when you combine these interventions, according to European Society of Human Reproduction and Embryology, you can take it from about 22% to 55%. Based on over 769 published papers, we have created a platform which takes a couple through a specific journey. Typically, we receive a prescription. A couple would receive a prescription from an infertilologist, and from the prescription, we would then do a screening. From the screening would entail 31 questions, independently done by the husband and wife. Then there is a group assessment done by a clinical psychologist, a clinical nutritionist, an andrologist, infertilologist, or a gynecologist. And then a specific program is chosen for them, which comprises of psychotherapeutic intervention, mind-body intervention, clinical nutrition, and dieting, which is delivered through self-care, expert care, and peer support group care. At the end of which, we are hoping that per cycle of intervention, which is fertility treatment, which is usually a 3-month period, the normal take-home baby rate, which is about 20-22%, can be taken to 55%. And there is enough precedence to this in terms of paper. We did a product market fit with a clinical partner last year before developing the technology. And we learned a lot. And from there, we ended up focusing on development of the technology. Now there is a app, there is a platform for care delivery, and there's about 10 plus hours of digital therapeutic content, which is very similar to the content I created for myself in audio, visual, and virtual reality format. We have just received the ICMR approval for our ethics committee, and about 7 plus clinics with 11 centers totally have agreed to run clinical trials across 3 cities for us. We have already started patient onboarding in one of these clinics, and the other clinical partners will be onboarding patients from March. We are going to do a clinical trial with about 300 patients. And in addition to that, we have been running commercial pilot because what we are doing does not require regulatory approvals. The mode that we have is a lot of people would assume that we are competing with yoga practitioners or independent nutritionists, which is not what we are doing. We are a clinically validated, we will be a clinically validated platform post the clinical trial, which will get over by end of June with 300 patients. So we are going to be an evidence-based platform. We have created technologies which can do precise diagnosis of stress, grief, depression, anxiety, and other things, which will ensure we have defensibility there. And we provide, we work with clinical partners to get to market, which gives us an edge over B2C players who are yet to get a foot on the door. We are a team of about 25 people. The medical director of the company is from NHS UK, Dr. Ravi. Gopi is my co-founder and chief technology officer of the company based in New Jersey, and he spearheads technology. And Ashutosh spearheads, workforce development and talent management. Meera spearheads revenue. All of us cumulatively come with significant experience. Each of us comes with a little over 20 years of experience, and some of us are serial entrepreneurs. We have done this before. Not a big exit, but we have been there. We have gone through the cycle. In terms of revenue model, typically
Vijay, you have only 10 seconds left. Sorry.
Typically, an infertile couple would spend about 3 to 5 lakh rupees over a 1.5 year period to try to have a baby, and they have only a 30% chance of having a baby. We charge them about 30,000 rupees and get them to having thrice the chance of taking home a baby. We'll be happy to answer questions. Any other questions that you have? I have additional slides which I can use while answering those questions. Thank you.
Thanks, Vijay. Okay, panelists.
Vijay, one quick question. Are you planning to expand this to other issues as well?
Awesome, sir. If I can show you my screen right now, we are starting with infertility. After the clinical validation, we'll be expanding to prenatal care, from prenatal to postpartum care. That basically means the lifetime value of our customer, which is expected to be about 60,000 in the initial phase, would go up to about 1.5 to 2 lakhs over the entire life cycle of a family building process of the couple. Beyond that, our intent is to work with women as part of the menstrual health, especially working women. Again, focus will be on urban tech-driven people who are stressed. 62% of them are affected with menstrual irregularities and sexual wellness. So there's a certain roadmap. Pediatrics is a roadmap we have decided to do away with. We are going to be largely a family and women health company over the next 3 years. Yes, there is a very clear roadmap for that as well.
What's the current traction? Sorry, I missed it if it was covered.
We have not focused much on revenue generation. We have generated, here and there about 3.5 lakhs of revenue, which is not very significant. But as a company which has managed to raise only 1.5 crores, we have been saying no to a lot of people who have come in with money. We have been looking at specific kind of investors. We have raised 1.5 crores of money, and 3 lakhs is what we have generated as revenue. But to sustain our operations, we have taken up some projects in the tech space, which doesn't take more than 10% of our resources, and we generated about 37 lakhs of revenue there in addition to that. So, that's something we are doing. So 37 lakhs, 40 lakhs is the cumulative revenue, but I don't want to mislead you. Only 10% of this is from the patients so far.
So a couple of questions, Vijay. One is that do you have any success fee model from the fertility clinics that
Absolutely.
you are working with?
Yes.
That's the first question. So what's the percentage like?
Given that it's a B2B2C model that we deal with, after the patient has paid us every month, at the end of every month, we give about 15% minimum and maximum of 20%. We also want to share something very significant. We have generated a few patients and handed over to the patient or referred them to the clinic, where we generated much more. We get a quid pro quo of the same percentage, which generates much more revenue than what we otherwise make. So, yeah.
Okay, sure. The second question is the screening process patentable? Is it something that you've developed in-house?
Absolutely, very valid question. The current screening process, which is there in the public domain, is not patentable. But what we have created, for which we have received the Nidhi Prayas funding, it's a multimodal diagnostic process which uses facial emotion recognition, speech emotion recognition, body language analysis, thermal imaging, these combinations which we have been developing and testing and validating. It's already applied for provisional patent. We are going for full patent by April this year. And we are going to file patent across the world. We have necessary resources to do so. The revised version of the prototype, which is being tested, is being co-built with IIIT Hyderabad and with few other institutions as well. So we are hoping to have the new patentable version by June this year, just to give, which gives a huge defensibility as a company for us.
A softer question, Vijay, what is the kind of feedback you've received on your screening process? Because I think in this case, customer feedback would be a very, very important factor.
So let me start with the pre-pilot we did. I'll just give me a moment, please. The problem solution fit we did at a fertility chain in between Jan 20 and March 2021. comprised of a little over 88 couple who went through the screening. Then we had about 30 couple who went through assessment and only 4 couple who went through treatment. The first challenge we realized was people were not able to comprehend the questions in the first place. Which is when we started translating these questions into audiovisual formats, and we have received positive feedback since then. And we don't even wait for people to respond to it. We are just analyzing their facial emotion. We are getting to analyze, collect the response in that way. So we are not really going subjective. We are going very super objective on this. We are translating the emotions to specific or reaction to emotions, emotion to conditions. That's how we are doing it currently. Yeah.
Vijay, I'm sorry, I'll have to, kind of, I feel very, very sad having to cut you off, but
that's all right.
Unfortunately,
are there any questions that I can answer? We are looking to raise another 1.5 crores, and we are looking at people who are good in the space and who can help us, come with strategic value in the GTM part of it.
I think we'll set up a separate conversation for
sure.
you.
Thank you so much.
I think there's sufficient interest.
Thank you. Thanks for the opportunity.
So thanks, Vijay. And we'll quickly have, I think we have about 10 minutes. I'm going to request the panelists to see if they can extend by another 10 so that we can squeeze in 2 startups. So we have EFIL, we have Mayank Jain. Can you come on, please? Mayank, we can start. Mayank, are you there?
Yeah, hi, good afternoon. Yeah, hi, good afternoon all.
Start, Mayank, we are waiting for you. Please start.
Okay, is my screen visible to all?
Yes, it is. Yes, it is.
Okay. So basically, I'm the co-founder and CEO of EFIL Electric. And at EFIL, we are empowering the complete EV ecosystem through our smart charging solutions and the 3-wheeler mobility products. So talking about, just a minute. Yeah. Talking about the charging segment, so we provide end-to-end solution in the EV charging domain through in-house developed the hardware, CMS, which is a central management software, and mobile application platform. Wherein in the mobility segment, we manufacture smart and efficient electric 3-wheelers, both in passenger and loader category, and the e-rickshaws are already ICAT certified as per the FAME 2 guidelines. Further, we are developing L5 category product, which is a bigger L5 electric auto. We are planning to launch that in the mid of this year only. And talking about the revenue model, so for the charging segment, we are going forward with B2B and B2G for the government projects. And in the mobility segment, we are going with B2B2C through our dealership channel partners. Further, talking briefly about the major clients. So we are working with few corporate clients like Sun Life Insurance, Gulf Oil, Power eBay, Charge on the Way. So we are working currently with more than 15 CPO, charge point operators, to whom we are providing our hardware also, our CMS also, and we support them through for the installation and commissioning services also. And in terms of traction, so the traction, the financial year 2021, we closed at close to 1 CR, and the revenue till now for the financial year 2022, it's close to 1.5, and we are targeting to take it to 2 CR this year. And this revenue includes basically the charging services, the CMS, and the R&D services that we are providing to some of the customers globally, basically Japan and US. And the sales of 3-wheelers would be starting from 1st of March this year only, because we are waiting for the DHI approvals for the subsidy. Although the ICAT approvals are done, but we are waiting for the subsidy for the DHI. And in terms of funding, we are bootstrapped till now. We started in mid of June 2019, and so far we are bootstrapped, and we have utilized the revenue coming from R&D services, and we have invested that revenue into the venture so far. And further, we are raising as a pre-series A, we are raising 7.5 million, and out of which 5 million would be invested in charging vertical, and 2.5 million would be invested in the e-mobility vertical for the various expansions like R&D and sales and operations part. So along with me, Rupak is a co-founder here, and he has a good rich experience of running a $100 million company in US in oil and gas sector with the ARR of like 18 to 20 million. And talking about myself, I have a background of 8+ years of experience into automobile R&D, and I have close to like 6 patents and 2 design applications and a couple of research papers so far. I'll quickly now talk one by one regarding the problems that particularly we are solving in the charging domain. So unlike major economies, India lack the charging infrastructure, and further the major pain point is that it is difficult to start the charging station as a CPO or the charge point operator, because you need to get the hardware from one company and from one OEM, then you have to integrate other software SaaS provider CMS, and then you have to take care of the installation commissioning. So at EFIL, we take care of the complete end-to-end issues, and we provide them hardware, CMS, and a mobile application platform to run the complete business. So this is typical our CCS2 DC fast charger of 15 kilowatt, and we have made it so compact that it can be easily wall mounted also, and it can be easily mounted on a stand like this. And we cater to different sectors like residential sector, commercial, leisure, and also highways. Further, these are the product segment that we have developed, and these 3 product segments we have already got NABL aggregated or the approvals from NABL labs. And further, this is the mobile application platform which we have launched on iOS and Android platform, and this is a CMS which is basically used to remotely manage and operate the charging station. Now talking about the market traction in terms of our reach, so we have 60+ charging stations installed so far up in the north, and we have clocked in a revenue of 42 lakhs in the last 3 months itself from the charging stations, and we are working with more than like 15 CPOs, like I said. And in terms of our associations, we have partnered with Park Plus and No Brokerhood to get access to their parking lots and the societies that they have on board. And now coming on to the 3-wheeler segment. So 3-wheeler segment, so the challenges that we are solving in that. See, in the 3-wheeler segment, the current 3-wheelers are basically having low range, and they lack safety and poor quality and design. Most of the products are being imported from China as a kit. So we have developed a complete end-to-end solution with a complete FAME2 guideline of 100% localized product with all the technology in-house. And we have filed a patent also for the convertible seats feature, wherein the extra luggage can be carried in the same 3-wheelers. So
Mayank,
these are
you have only 30 seconds left. Okay.
Yeah, so these are some unique features, like we have added first-in-class dual brake system, combi brake system, and dual gearbox, and we are giving a better range, like 100+ range. And we have 2 segments, loader and the passenger segment. Loader would be catering to the e-commerce and logistics players, and the passenger would be catering for the end customers like the e-rickshaw drivers. And we are asking like for 7.5, and we'll be deploying for different sectors like R&D, product development, and production scale-up, and the plant expansion. Talking about the team size, I mean, we are a team of 50+ members now, and our major focus is on product development and product building. And further, now we have started scaling on the sales team also. Happy to take your questions.
I think in interest of time, I'll just also give the feedback. I'll skip the good parts, of course, right, so that it is helpful for you. I think one is, this seems like you're stretching between, right? You're doing charger, you are doing 2-wheeler, you are doing 3-wheeler, you are providing global services, as I saw on the first slide. So just, I mean, of course, you know best what you are doing. I mean, just be a bit careful on that, right? I think so you're stretching a bit more both on the product side as well as suddenly on the geographical side, right? I think since if you're in the NCR area, for example, that's a huge market. Just figure it out there, the whole process, the customer experience. Once you have figured it out, right, you can replicate it much easily elsewhere, right? So that's the quick feedback from my side. And 7.5 million, and splitting half and half into these 2 sort of business units, for the current traction, may be a bit high, but of course, market is market. You may get it also. So yeah, that's it.
Thank you for
the sharing my quick thoughts. I would concur with Jatin. It looks like you're trying to do too much. So how do you want to position it? That's one thing I think you should look at. And second is the space of EV has so many players across each of the segments, right? There are quite a few players. So you will need to talk about how you are different, why your product will be procured, and how you are ensuring your GTM aligns with that? How are you ensuring that your three-wheelers, your charging points, etc., what kind of traction you already got in your order book, and how are you building your sales? That's going to be very critical.
Yeah,
All the
sure.
best.
Okay, so talking about the three-wheelers particularly, so we
I
have
think, sorry, I don't think we have time for the responses now. We were just
I'll also
sharing some
give
of
a
the
very
questions.
quick feedback. I think I concur in terms of your product and the charging point. The two separate businesses require two separate focus areas. Also, within the charging point, I think just the charging point for four-wheelers is a market in itself. The charging point for three-wheelers is a market in itself. And it's a very, very competitive space, even for government contracts. In fact, we have one of our portfolio companies, Charge Plus Zone, which is in the first business that you're looking at. And it is a difficult ride. There are companies which are very ahead of you in their life cycle in terms of their growth trajectory, etc. So I think you might want to do a bit of a rethink, but you know best in terms of, I think the 7.5 million might not take you very far if you're deploying it across both the verticals.
Okay. Mayank, I'm sorry, kind of really running out of time. So I'm sorry, I have to, we'll probably schedule a separate discussion with you. And thank you, panelists, for extending. So the last one we have is an interesting company in the robotics space. We have Arif here. Over to you, Arif.
Yeah, hi guys. 1 second. Let me share my screen. Yeah, can you see my screen?
Yes.
Okay, 1 second. Okay, so yeah, I'm Muhammad Talha. I'm the founder at Seven Robotics, and at Seven Robotics, we are building robot mobility solutions to automate material transport across various industries. Industries such as manufacturing, hospitals, warehouses, and airports. A typical use cases could be automating cart movement across warehouses or manufacturing facilities, delivering medical consumables in hospitals, or doing collaborative picking with humans in e-commerce and 3PL fulfillment centers. 1 second. Yeah. So across these various industries, the crucial issues that we have identified after extensive engagement is unavailability and unreliability of human labor not only affects these facilities but also affects the productivity of their downstream processes, and more than 83% of warehouses globally are completely manual. So it sort of leads to a lot of human errors, picking errors, which end up impacting the bottom line profitability of an organization by a huge margin. And if you look at most of the manufacturing facilities, more than 25% of their labor force is allocated only for the sake of material transport. They have no other skill set except for moving material from point A to point B. And for industries which are trying to be as nimble and resource efficient as possible, this isn't ideal, and this isn't something that is going to scale. So automation is the only way forward. But the problem is the existing industrial automation solutions that are available at their disposal require a huge amount of investment in terms of capital as well as time to deploy and configure these solutions to be up and running. Contrast that with our solution, where the robots could be deployed in 1 to 2 weeks. In fact, the entire solution could be deployed in 1 to 2 weeks. The robots are, operational right from day one, and an ROI could be delivered in 12 to 14 months. And since these robots are completely safe to operate alongside human beings and can collaborate with human beings in various material transport activities, they not only improve the productivity of your existing labor pool, but they also reduce requirements on excessive labor. And in 3PL and e-commerce fulfillment centers, robot-guided picking is bound to drive error rates down to almost 0%. Our product offering is pretty simple, yet versatile, and suits the requirements of the industry. We provide modular robots, which are cloud connected and can handle different payload capacities ranging from 20 kgs almost up to 1 ton. And like I mentioned earlier, these could be deployed within 1 day. And couple that with the cloud robotics platform, which enables the end users to automate all their material transport processes with the click and drop of various utilities from the interface. Integration with third-party ERP and WMS systems is pretty simple and straightforward. The end user has the ability to monitor the robots in real time, the different material transport processes that are happening in their facilities in real time, and robots performing one task can be switched over to a completely different task, like from picking to sorting, all from the interface without having to go through an extensive reconfiguration process. Our business model is pretty straightforward. It has 3 different revenue models: direct sales or capital expenditure model, where the robots and its accessories are sold as a commodity with a fixed margin and an annual maintenance contract to go along with it. And for industries which are unwilling, are on the fence, or not sure about investing so much in this solution, we provide robotics as a service revenue model, where essentially a pay-as-you-go revenue model, where the end user only pays per metric usage of robots and its accessories. And the cloud platform is provided separately as a software as a service solution. The total available market for a solution in India, Middle East, and Southeast Asia is about $2.68 billion, and the projection for 2025 is $9 billion. We are currently raising our pre-seed round of $300,000. This will allow us to extend our technical team and to do major pilots with major customers that we are currently engaging with in India, out of which we have already raised $120,000 with a couple of key marquee investors from India and USA. And our team has a very healthy mix of robotics expertise, logistics expertise, and we have product engineers who worked at global product companies such as Volvo, Apple, and Tesla, guiding product development and product market fit. And currently we are interviewing and hiring for other key positions as well. So that's it. Didn't want to push it too long. If you guys have any questions.
Arif, one question: what's the current revenue?
We are pre-revenue, so we are starting our POCs, pilot projects in April. We've done 1 pilot project, and we are currently planning 5 pilot projects for this year. So the money that we are raising is going to essentially go into building more robots for pilot projects and expanding the team.
Thanks, Arif. Abhiram, Shivangi, quick questions.
Thanks, Arif. That was a great presentation. All the best for the journey ahead. Couple of quick thoughts. I think we have seen quite a few startups in the robotics space, and especially working with 3PL and distribution centers. So I think one thing that you can include in your deck is the overall competitive landscape and where you are playing and how you would be different.
For the sake of time, I didn't go over that, but yes, if you want, I could go over it in brief.
No, I think we're already running short of time, but thanks.
What's the unit cost you are planning? What's the average cost?
Right now, the average cost is something that we haven't yet finalized because we are still in pilot projects, but it's safe to say that we are targeting at least 30-40% less cost than what the market price is.
Yeah, the reason I asked is because you are trying to provide the RAAS service, right? Because that is capex on your books and working capital requirements and all that, right? That's all.
Yeah, absolutely. So RAAS is essentially there for people who are like large projects where they are on the fence, just to convince them. But initially, our focus for the first 2 years is going to be capital expenditure model.
Sure.
I think for the sake of time, I'm going to refrain. I think my comments would concur with both Jatin and Abhiram, so I'll just stay out of this one.
Okay, thank you.
Okay, so I think I'm not going to impose any further on Abhiram and Shivangi and Jatin. So first of all, deep, heartfelt thank you to Abhiram, Jatin, and Shivangi for taking the time. We've taken 20 minutes more than was originally planned for. Thank you very much. And of course, to all the startups which pitched, I hope they got some useful insights and perspectives. I know the time was limited and probably needed a deeper, we probably would have liked to have more time. And of course, to all the participants who stayed on, I hope they found value and got some insight. Again, thank you very much. And is there any quick closing comments from Abhiram, Shivangi, and Jatin?
I think on a lighter note, I would just say take a lot of things that we say with a pinch of salt. Investors are also wrong many times. That is why we all have our anti-portfolio section. So do not get disheartened by any constructive feedback. Yeah, that's it.
Yeah, in fact, I'll add to that, and just like you set up the session for startups, saying what do VCs think? I think we should have one session. What do startups look for in investors? And we can ask them questions.
We'll do that. That's our next series, Abhiram. I'm going to take a rain check from all of you on that. So.
Sure. I think as a closing comment, I'd like to quote Edison when he hit upon the light bulb. He said, "I just found 10,000 ways that didn't work." So again, just don't be disheartened. Keep at it. We are not the end of the world. So just because we say something, it doesn't mean anything actually.
And thanks for having us on behalf of all the panelists, I guess. Yeah. Thank you so much.
Thanks. For
Thank you.
Thank you.
Thank you, Abhiram, Shivangi, and I'll connect with you offline. Thank you very much.
Thank you. Bye-bye.
Thank you, everyone.
I think there's an announcement from Startup India. So I think Akansha is here. So over to you, Akansha.
Thank you so much, Srinivas. I believe I can't switch on my video yet, so the host will have to.
Shankar, could you switch on Akansha's video, please?
Akansha, yeah.
Thank you so much. This is regarding the National Startup Awards 2022 that has been launched recently. So I've just shared my screen and I won't take a lot of your time. And I believe most of you will be aware of what the Startup India scheme is. Now, my entire presentation was about how to get a DPIT recognized startup. And if any startup is here, I believe there are about 80 startups. If anyone is not DPIT recognized yet, it's a very simple process. You just have to fill an online application that takes 15 minutes. The application gets evaluated within 1 to 2 days, and you get access to government procurement through the GEM. Patent-related rebates, tax benefits such as the ATIAC, as well as Section 56 benefits. A lot of these benefits are linked to being a DPIT recognized startup. Now, the main purpose of this presentation was to take you through the National Startup Awards 2020 and 2021, which were the previous editions. We have hand-holding support to our National Startup Award cohort in terms of investor connects, regulatory support, international market access, and now even in the 2020 cohort was also given the access to have their own Doordarshan show where the winners had sector-specific episodes which Doordarshan had aired. Now we have the 2022 applications that are open. The final date is 15th of March, and it's a very simple process. There are about 17 sectors, 50 subsectors, and 7 special categories. As you can see, as being an NSA National Startup Award finalist as well as a winner, you get 5 lakh for each subsector and 15 lakh to each incubator and accelerator. The eligibility criteria is extremely simple. You have to be a DPIT recognized startup. The entity must have a hardware or a software product that is currently present in the market. All compliances in terms of trade specification registrations have to be met. You should have not defaulted in any of the 3 previous years, and if the startup is less than 3 years old, you should have all the financial statements available for the previous years. The application process is extremely simple. I will not take you through the entire process, but it's available on the Telangana State Nodal's website as well as our Startup India website. The eligibility criteria for incubators and accelerators is nearly the same. Both have to be an independent entity. Both have to be operational for the last 2 years at least. The only difference is that the incubator must have graduated a minimum of 15 startups and the accelerator must have graduated a minimum of 10 startups. So these are the special categories that are available. Each startup can apply for up to 2 categories, 2 different categories and 2 different sectors. So if you have any questions regarding the National Startup Awards 2022, I've not gone into the specifics of it, but let me know. You can reach out to me directly. You can contact Startup India directly regarding this. Our applications are open right now and our final date is 15th of March. Thank you so much.
Thank you, Akansha. So Akansha, is this presentation public domain?
It is not, but most of this information is available on the Startup India website. All of this information, actually. If you want, I can share it with T-Hub as well.
Yeah, if you could, please, that would be helpful.
Absolutely.
Whatever URLs are relevant would be.
Right. We do have certain URLs here, the Startup India application form, incubator application, accelerator application. All of them can be accessed on the Startup India website as well. So I'll share the presentation.
Okay. Any questions from the audience? If not, we'll kind of run out of time. First of all, Akansha, thank you for taking the time.
Thank you, sir.
I do hope you'll see a lot of our startups reaching out to you.
It's a great opportunity for startups to undergo this sort of handholding support from Startup India as well. So we definitely request everyone to have a look at our application form and see the past applications that we've seen.
Okay, so so I think we come to the close. I first of all want to thank the team at T-Hub, Mansi, Shankar, Simple, and a whole lot of other people who've been involved in collating all the startups and putting this together. And of course, I do hope the panelists really enjoyed the interactions they had. And I do hope all the participants benefited and took away some, had some good takeaways from what they listened to. And of course, last but not least was the Startup India session. So thank you. And we will connect with you separately. I think we've shared mail IDs of people who can be reached out to take this conversation forward. Yeah. Thank you very much, and have a good weekend. Look forward to more such sessions from us. Thank you.